We've been through another interesting period in the markets, and it's really quite ironic that the Federal Reserve sits at the center of all of it when we have moved to a Federal Reserve that has now desired to provide less transparency and no forward guidance. What that has left markets to decide is, with each incoming data point, all of the potential options for the Fed and what it could mean for monetary policy, for interest rates, and for the broader economy. That means volatility is back, and we have certainly seen that. Following the Fed's meeting just a couple of weeks ago, we saw markets react very sharply. We saw the curve steepen quite dramatically as Chair Warsh, while standing at the podium, harped on the fact that the Federal Reserve recognizes that there is an inflation problem, but did not offer any guidance as to when or how they plan to do something about it, and that spooked markets. So what we have seen now is a steeper curve, as I mentioned, and also volatility back in terms of interest rates. And what it has done, it has put a bullseye on every inflation data point that we get from now until the next Fed meeting, which is just a few short weeks away. So that leaves us wondering, when will the Fed act? A lot of speculation that they will, in fact, raise rates in September. Our view remains that they don't need to do that. The Fed has consistently missed their 2% target for 5 years now. And by their own forecast, it's 2 more years out before they get there. There's time for them to be patient and let some of the, dare I say it, transitory impacts of inflation work their way through the economy and get a better picture of what real inflation looks like as we get towards the end of this year. That's where we think it's appropriate for the Fed to move. In one of the last meetings of this year, to raise rates by 25 basis points, perhaps another move when we get into 2027, and pause and see what the impact of all of that might be. In the meantime, as I said, we're susceptible to waiting to see what each economic release is and what that could mean for potential outcomes. Those economic releases, however, remain really supportive, showing an economy that is growing at a very nice clip. While GDP came out at 1.5% in the second quarter, that number masks what's going on underneath the surface, which is the fact that personal consumption came roaring back and was up 3.8%. The reason GDP was lower is because of trade and inventories. And when you take those out, there's still a strong economy in the U.S. That's helping to support the consumer, as are the labor markets. We still have good data around the labor markets in terms of growth and expansion in non-farm payrolls, as well as the fact that initial jobless claims have hit a 60-year low. So the consumer is well supported by the fact that they have a job. Wages are trying to keep up with inflation, something that will be watched very closely in the months ahead. And that leaves us with the same thought that we've had for quite a while now. We remain constructive. We see that as supportive for fundamentals across most of the spread sectors that we invest in. And with yields moving so significantly higher over the last few weeks, there's a great opportunity still in spread product to add really nice income enhancing all-in yields for our client portfolios.